Hi, and welcome to this week's edition of Macro Minutes. I'm your head of trading, Mark Gardner. Let's start off with the normal formalities. The information summarised in this webinar does not constitute financial or other professional advice. It is general in nature and doesn't take into account your specific circumstances and should not be acted upon without a full understanding of your current situation and future financial goals. Okay, stocks in our universe for this week. We've got Webjet, Aristocrat and S32. So we had Webjet announcing his financial year 21 annual results on the 19th of May. 9-month loss of 156 million. We will with a monthly cash burn around about 5.5 million for the same period. Underlying EBITDA basis, it's a loss of 56.3 million was reported. Web's domestic bookings 1.7 times ahead of the average bookings. Company's well positioned to take advantage of the travel market as we reopen, as we all know. Domestic bookings stood at 95% of April 2019 levels. So that's a huge positive. From memory, I think it's about 80% of Webjet's business or thereabouts is domestic. So that is a good improvement. They're some of their other projects like their WebBeds division reported a 46.9 million loss for the reporting period. Division still hit by COVID in most regions. It has a lower domestic bookings and last minute bookings leverage. In April 2021, TTV WebBeds at 83% of COVID levels in the US. I think they've got some UK operations there as well. And the UK is coming up to full reopening in June, hopefully. There's a few minor concerns about the Indian strain over there, but they're looking at being the first ones to be at herd immunity, 55% of population. So they'll probably be a pretty good example. They did announce a transition to a new reporting period in August 2020, hence the 9-month results. But on the flip side, though, Qantas announced yesterday that they're going to drop their fees to these travel agent companies from 5% to 1%. So that saw the share price drop about 4 or 5% in Flight Centre and Hello World and Webjet. Look, these travel companies now, from the trading point of view, the trading department's had this on a couple of times that we've cut out for lockdowns and things. Basically, the market now, I think, is just a little bit fatigued, a little bit tired. All the bad news is built in, essentially. But I really don't see a massive amount of upside in these, and we're more than likely going to be seeing, flat to sideways movement for probably the next few months at least, because these things have been bought up on trying to predict the reopening, and that preemptive trade hasn't worked a few times now. So I dare say the market's probably going to wait until there's some surety about recovering numbers, rather than these false starts that we've had here in the last few months. So look, you'd probably be looking at maybe being happy to miss the first 5 to 7% or 5 to 10%. Upside move when it properly stabilises and starts to head back up, just to make sure that there's going to be no little nasty surprises, which certainly has been a consistent run of with these companies. But overall, they've got a good economic moat, and because they've done a lot of capital raising, so it is the favoured one in this space. And particularly with that WebBeds business, obviously it's really hurting them on cash burn. However, once we start to see travel really reopen and get back to any sort of pre-pandemic and normal levels, these guys will be the one that benefits the most. Aristocrat was a investing department recommendation from around about the 10th of January. It hit price target of $40 on the 17th of May, basically resulting with including the dividends, about a 13.6% gain there. So it's sort of almost more in my sphere, realistically, in terms of time frame. So it's a really good one there from the investing department, picking up some really good value there early on in the year. Basically, this price movement to the upside came on the back of their half one 2021 earnings, which saw the stock price raise about probably 8% on the open. I think it settled on the day around about 3 to 4% up, with normalised NPAT of 412 million up 12% and normalised EBITDA of 750 million up 6%. Strong growth from a recovering economy with the stronger than expected consumer sentiment in the US, Australia, New Zealand. Digital business boom with greater demand than pre-COVID levels. One of the top 5 gaming publishers in the Western markets. So overall, look, even though the investing's bailed out here at the moment, I think from what I have heard, on the trading floor, we may be looking at recommending that sort of one again. It's obviously trending in the right direction, look, it's certainly one to have on your watch list anyway, if there's any significant pullback, because they seem to be going in the right direction. So next we got S32, so Australian-based mining company, refining, smelting of natural resources like aluminium, alumina, metallurgical coal and manganese, operates South Africa, Brazil, Australia. So business restructuring with a bias to the base metals, important for low carbon future. S32 announced on the 17th of May that it will complete the divestment in its South African energy coal business to Certi by the 1st of June. With a loss on the sale of between 125 to 175 million. Obviously, Brazil having pretty significant, Brazil and South Africa having pretty significant COVID issues. This comes due to the changing worldview on coking coal, and development of mines can only be justified by much higher financial returns. S32 Eagle Downs, a joint venture with Baowu, China's biggest steelmaker, coking coal project appears to be no longer attractive, despite no viable alternative to coking coal. Extreme low prices due to dented demand for coking coal caused China's ban on Aussie coal, and India's pandemic crisis approaching monsoon season continue to apply pressure in the short term. The divestment is expected to strengthen S32's balance sheet and provide additional flexibility to the company in respect to future allocation of capital. The loss on the sale will be excluded from S32's underlying earnings, and South Africa Energy Coal will be shown as a discontinued operation in their financial year 21 results. This is expected to see underlying tax effective rate remain elevated at a range between 35 to 45. Overall, not a massive fan of this company, given all of those things. They realistically they're mining, dying commodities basically. I think that, in my personal opinion, I really think you can definitely find better alternatives out there in the investing sphere, both from a opportunity point of view and an ethical point of view. But obviously that's general advice only. Here we go. Stocks to watch out for this week. So CNI, SEK, and CIA. So CNI, they'll be going ex-divvy on the 24th of May, and will pay a 5.5 share dividend on the 30th of July. This is a current trading department recommendation on the basis of the company's got very strong management. They're very much have got a great track record of in acquisitions, getting good deals, buying in the right space, and basically this recent acquisition, which is an off-market takeover of Prime West Group, which gives them geographical diversification, but also puts them into about the $2.4 billion market cap range, which slots them into the ASX. So that will be going into the into the index on the rebalance in it's usually around about 14th or 15th of June. So the merger will take place, I think, just prior to that. But we've got a unanimous recommendation from the Prime West Group's board. They're bringing over some of their top staff as well, which is always a smart thing to do. So they're bringing them in really raises them up. It creates an entity with 15.5 AUM, lifting the CIA current AUM by 48% there. Basically, despite JP Morgan and UBS agreeing the transaction is expected to be 4% accretive to the earnings in financial year 21, integration risk is prominent, with C&I's strategic focus to retain primary staff post the 2-year escrow period due to new sector exposures. The group had outlined in the early year a $1.6 billion development pipeline, with most assets to complete across the next 3 to 5 years. I do quite like this one. Like I said, it's a current trading department recommendation. When we had a significant shareholder sell out of 17% of their business, I think about 3 days ago at $2.60. I think the price settled at $2.75 that day. And since then, look, there was some selling on the open. The trading department actually increased its position around about the lows at 255. And since then it's ground back up to around about that 262, 263 mark, back through the price that they sold out at. Apparently, Morgan Stanley didn't have a huge amount of trouble getting rid of those shares, so you probably expect that one to drift back up. And that property sector, obviously, as well, is not a bad one to have for inflation. Property being a fairly reliable inflation hedge overall. Rightio, we're moving on to Seek now. Seek went ex-divvy on the 10th of May. We'll pay out 20 cents per share on the 25th of May. Dividend was announced with the guidance upgrade due to improved operating conditions, including the highest number of job advertisements since 2008. We did have job numbers yesterday in Australia. The unemployment rate's down to 5.6 now, even though the amount of jobs actually fell. They were mainly part-time jobs overall. So we're one of the only economies in the world with that has gone back through the pre-pandemic employment levels. So a company like this obviously would be, you would hope, would be outperforming. So the upgrade was driven by our performance of the job market relative to the expectations, with Seek Australia, New Zealand, Seek Asia, small and medium enterprises driving a 40 million upgrade in revenue and a 50 million in EBITDA for 2021. Share price has been pricing in an expected earnings upgrade, recognising the impact that the record fiscal stimulus has pent up demand would have on the creation of jobs. The share price rallied 26% from late February to early May. When the upgraded guidance was released, Seek has seen the market profit take on the good news, with the share price sliding about 12.5% since. Look, it's one of those ones. Obviously, it's given back half. It's usually not a bad thing to be buying. They're obviously in an upgrade cycle at the moment. Significant pullbacks to anywhere around those February levels. You will probably be having a look at that stock again, and as we're probably going to see things return to the norm. Next up, we've got Champion Iron. We'll be announcing its fourth quarter and financial year 21 year-end results on the 27th of May. It announced its quarterly activity reports on the 28th of April, exceeding March quarter production forecasts with a new annual production record. Champion has enjoyed the rise in iron ore prices across 2021, running 30% to all-time highs at $229 per tonne. That's iron ore, that is. That was on about May the 13th. But to talk about iron ore prices, they have pulled back a little bit. They did dip below $200 and then went back above. Realistically, I'm hearing a few analyst comments on the iron ore price that even a pullback to 180 is probably a healthy thing for the overall industry. Because it basically at $229 per tonne, it really does take out, cause some issues for people purchasing for steel manufacturing. And at $229, people are going to start hunting around for alternatives to iron ore, like recycling. So, a pullback in the price is not necessarily a bad thing for iron ore. Most commentators are saying that price is fairly transitory, and more than likely just due to the fact that China's dual boning over the last period, saying that they weren't going to buy it and then actually buying it, probably caused some pent-up shorts to get squeezed out. So production at record highs. Champion's expected to beat expectations in the earning announcement. alongside those favourable iron ore prices. They also announced the approval of its Bloom Lake 2 expansion and the finalisation of the Kami project. The projects are expected to continue strong production and pipeline for the company. Share price rose by about 10% after the quarterly activity statement and has risen about 38% year to date in 2021. Look, it's obviously going to be fairly based on the iron ore prices, etc. But you know, as I said before, realistic prices, which are still very elevated at 180, are probably not such a bad thing for the industry, because it'll really stop people searching for alternative ways to make steel, which China's already worried about, considering their willingness to head towards pollution and carbon output targets. Right, looking ahead, global economic data. Tonight we've got European and US and UK flash manufacturing PMIs. The PMI numbers are the earliest look at purchasing managers' activity. They're leading indicators. Basically, there's been some, the recent numbers have been quite high, showing inflationary pressures. So we actually have that out today in Australia as well. So pretty much you're getting a global manufacturing PMI. I think China's was out last week, and from memory, it was in line or slightly less, I'm pretty sure. Those numbers can be a little bit volatile, and I think the previous months, the inflation story started to rear its head up, but it appears as though we've had talk of tapering this week from the Fed even, in their FOMC minutes, and high CPI numbers, etc., which the market's largely ignored, actually, which is very surprising, and bond markets have ignored. I would expect that to creep in again at some stage. I don't think the market can just blindly ignore this, but it's been very much a spike in volatility this week. The market's very unsure and very nervous. Thankfully, bull market's strong enough that we've managed to even though we've had some flighty moves to the downside, having the biggest one-day down move I think since February on Wednesday, we've seen some decent strength. Australia being quite lucky because commodities were rising in that period, which is about 25% of our index. So we're much more of a value index compared to the US. So we should fare better than things like the S&P and the Nasdaq, particularly, just due to the fact that they're obviously much more highly weighted in tech, whereas Australia's only around that 2 to 3% mark. Next Thursday, 10:30 p.m, preliminary US GDP. Obviously, it's a primary gauge of economic health. Whilst it isn't the earliest GDP data to be released, it does help to confirm advanced data. I don't think they're looking particularly at growth numbers, and growth numbers obviously coming off, particularly year-on-year numbers. We're now hitting to the point where we saw the sharpest effect of the COVID pandemic from last year. So year-on-year numbers are really volatile, and the movements are quite large. So you probably want to be focusing on the month-on-month numbers there. And also we've got new US pending home sales in the US. It's a bit of a leading indicator as well. It'd be interesting to see the ripple effect of commodity prices affecting building prices, etc. It's a good. Obviously, it involves mortgages, renovations, and brokerage costs and finance, etc. So it's not a bad one as a leading indicator. I don't think too many of those numbers in the housing sector are going to really affect the market greatly, nor the GDP. Still think we're probably slightly focused on inflation here at the moment, and I think the word tapering is something that you want to be, particularly from the Fed, is one you just want to be watching out for, because any movement in the timeline forward in that reduction of QE is going to really release the hounds on inflation. which will really affect that growth into the market. So, as per previous comments, either on this webinar or from the trading department, etc., it's probably wise at the moment to be in that value stuff, those value stocks, and probably avoid the growth part of the market just until we gain our footing again and get a much clearer outline on and timeline on central bank movements and inflation. So, not to say that high quality companies won't get cheap at times. So basically, just be a hell of a lot more selective, I would say, in those in that growth sector and the small caps, and things like commodities and financials should continue to do quite well. You know, on the broader scheme of things. So for you investing clients, this actually, a period of nervousness actually might provide some great opportunity to get into some really high quality stocks at good prices. For the trading clients, obviously, you just want to be mindful, given you've got a shorter time frame, that a pullback in the index can see your stops being triggered. So there is a definite need to be a bit more selective, but and show a little bit of caution. But within that, obviously, there is opportunity as well. So make sure you're doing your research and reading your emails and following your recommendations from the investing, trading, and your advisors, because this is really one of these periods where being lackadaisical with your stock selection can really affect your long-term gains. And see you putting on certain things into your portfolio that just really it's not the time for. So that really wraps things up. Thanks for attending the Macro Minutes. We will speak again next week.